Hi, welcome to Bookie. Today we will unlock the book The Intelligent Investor. When it comes to stock investment, most people's first reaction will be to think of Warren Buffett, the Oracle of Omaha. The book we're reading today is written by Benjamin Graham, whom Buffett referred to as his mentor for life. When unlocking Buffett, the making of an American capitalist, and the snowball Warren Buffett and the business of life, we mentioned that Buffett read The Intelligent Investor in 1950 when he was 19 years old. The book struck him immediately. Not long after, Buffett enrolled in Columbia University's business school, where he studied value investing with Graham as his mentor. 3 years after graduation, Buffett got a job at Graham's company, and during his first 2 years there, Buffett learned about value investing strategies and grew his wealth from $9,800 to $174,000. When Buffett read The Intelligent Investor again in 1972, he said, "I read the first edition of this book early in 1950 when I was 19. I thought then that it was by far the best book about investing ever written. I still think it is." Since its initial publication in 1949, the book has been regarded as a world-renowned classic in investment practices. It has been considered a revolutionary text, often referred to as the stock market investing Bible by investment gurus such as Warren Buffett. Buffett even wrote the preface and commentary for the book. It's been 40 years since the fourth edition of this book was published, and you may be wondering if the investment strategies mentioned in the book still hold true today. In fact, Graham himself emphasized in the introduction that the book focuses more on the principles of investing and the attitudes of investors. Therefore, we can still learn a lot today from this perspective. Benjamin Graham, an American economist and investment thinker, is the founder of value investing theory. He is known as the Dean of Wall Street and the father of modern security analysis. Graham was not only Warren Buffett's research supervisor at Columbia University's business school, but also regarded by Buffett as his spiritual mentor throughout his life. His security analysis theory and knowledge of the field was a tremendous shock to the investment field, affecting almost 3 generations of the biggest fund managers on Wall Street. Next, we will unlock the book for you from 3 areas. First, the fundamentals of value investing. Second, investment suggestions for defensive investors. Last, investment suggestions for enterprising investors. Let's first take a look at Part 1, the fundamentals of value investing. In the introduction, Graham stated the purpose of this book is to supply in a form suitable for layman guidance in the adoption and execution of an investment policy. So, what exactly does investment and speculation mean in this context? What's the difference? Graham pointed out that an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Investors should have at least 3 essential characteristics, the first of which being rational analysis. Investment decisions should be based on a rational analysis of the target company's operating performance. Second, safety. Investors should pay attention to avoid risk and heavy losses wherever they can. Finally, the last characteristic is reasonable expectation. Investors should expect the appropriate performance from the stocks they invest in rather than expecting too much. In real life, especially in the media, it is customary to refer to everyone in the stock market as an investor. However, Graham argued that not everyone who invests in stocks can be called an investor. The most fundamental difference between investors and speculators is their attitude toward changes in the stock market. From the perspective of speculators, stock profit mainly comes from the fluctuation of the stock price. They will buy in when they predict the stock will rise and sell when they predict the stock will fall. All of this investment logic revolves solely around the stock price. Speculators are mainly interested in predicting future market fluctuations. Investors, on the other hand, are less interested in a stock's price movements. They are more interested in buying and holding the right securities at the right price. Investors